Morning, everyone. I'd like to call the 9 a.m. meeting of the Investment Advisory Committee to order. We welcome all of our staff, guests, and those that are calling in to our meeting. If you'll stand and join us in our Pledge of Allegiance. Pledge allegiance to the flag of the United States of America, to the republic which stands one nation under God, indivisible, with liberty and justice for all. Then our salute to the North Carolina flag. I salute the flag of North Carolina and pledge to the old North State love, loyalty, and faith. Thank you all. Then I'll turn it over to Ben Garner, our General Counsel for Office of State Treasurer, to determine a quorum.
Good morning. Let's go ahead and take a roll call. So, Mr. Anarella. Mr. Brewer.
Here, good morning.
Morning. Mr. Cook. Here. Mr. Bevin. Mr. Patterson. Morning, here, sir. And Treasurer Falwell.
If they're on.
Are they on?
Can you see if they're on, if they've signed in?
I think Mr. Bevin's will be in and out. So.
Okay. All right. We do have a quorum. So, real quick, a couple of reminders, committee members, for our public meeting. For those who've called in, please remember to mute your phone when you're not speaking. Please state your name if you have to make a motion or second a motion. If you need to leave the meeting, committee members, please let us know. And then please identify yourself when you rejoin. Today's meeting agenda is posted for the public on the Department of State Treasurer's website, www.nctreasurer.com, at the Investment Management Division page. If we lose connection altogether, which we don't so much anymore, but we did a while ago, if we do, the meeting will be deemed in recess. We'll put a notice on our website, and then we'll have information about when we resume the meeting.
I will have that John and Lentz are signed up.
Okay, so Mr. Lentz and Mr. Anarella signed up. All right, thank you.
Okay. With that, we welcome everybody. Today's, well, he's already read that. So
Approval of the minutes.
with that, I'll entertain a motion to approve the minutes without objection. We'll consider any motion or a second to be considered yes votes.
So move approval.
Second. A motion and a second. Any further discussion? Hearing none, the clerk will call the roll.
All right, Mr. Anarella. Mr. Brewer.
Yes, aye.
All right, thank you. Mr. Coakley. And Mr. Patterson, Treasurer Falwell.
Aye. All right. With that, we're getting ready to go into a long, detailed discussion with our performance update and our asset liability study, which is the first one that's been done in 5 years. Then from that, we'll go to Ron Funderburg and talk about inflation sensitive, and then member comment, public comment, and adjournment. So that we'll turn the meeting over to Christopher Morris and Jeff Smith, our co-CIOs.
Good morning. Glad to see some faces in the room today. I'll touch on real quickly the topics of the fourth quarter, which feel like a lot of more of the same, really, from the last time we sat down. So really the story was about a surge of a new variant with Omicron in the fourth quarter, continued inflationary pressures, supply chain issues. So a lot of really more of the same. We did have Fed announcement around the acceleration of the tapering of bond purchases that occurred kind of middle of the fourth quarter. On the backdrop of all that, we still had solid corporate earnings. Over 80% of the S&P 500 companies reported earnings over street estimates. That really buoyed and kind of helped equity returns still stay positive despite all the challenges. Labor market continued to recover. Jobless claims fell. Unemployment rate declined to 4.2% in November and hit just right at below 4, I believe, was the December reading. On the treasury market front, a flattening curve as the short end, intermediate end, we saw rates rise to kind of anticipate the moves from the Fed upcoming, anywhere from 15 to 40 basis points, depending on the spot on the curve, while the long end actually saw the curve rates decline slightly On a spread basis and investment grade, some mild widening out, about 10 basis points on average in the markets. With that, I'll turn it over to Chris.
Great. Good morning, everybody. Turning to slide 7, looking at our assets under management for the investment. Total assets as of the end of calendar year was just north of 176 billion, which again is another all-time high. It's up about 3.5 billion from last quarter. The increase was mainly due to the appreciation of the pension plan, as equity returns were pretty strong in Q4. That portfolio increased about 2.5 billion. The other pools all slightly increased as well as markets moved higher. Moving to slide 8. NCRS asset allocation as of December 31st. Portfolio ended the year at 123.8 billion, which was just off the all-time high of about 124 billion that it hit at the beginning of November. No major changes in portfolio positioning. Growth underweight currently at 8%. The majority of that coming from public equity. Overweight to rates and liquidity of 9.4%, with the cash portfolio comprising all of that overweight. IG fixed income was slightly below target as of the end of the year. 1.3% underweight to inflation sensitive and diversifiers, and we remain close to neutral on the multi-strategy portfolio. Moving to the next slide shows a more current snapshot. You can see the portfolio's value has decreased some year to date as markets have struggled. Value was 119.5 billion as of about a week ago. It's slightly lower than that today as markets continue to come back slightly. In terms of allocation, no major changes since quarter end, so similar over and underweights. Moving on to slide 10, the portfolio performance versus benchmarks. The portfolio as a whole was up about 2.5% for Q4, driven by the strong equity markets as well as strong returns from our alternative asset classes. Fixed income was largely flat for the quarter. 1-year return you can see was 9.7%, which exceeded the actuarial rate of return by over 3%. And looking at longer term performance, portfolio has exceeded the actuarial rate of return in every time period shown here, except for the 15-year, which was just slightly under the 6.5% actuarial rate of return. So certainly good to see that the portfolio's longer term returns are over that 6.5% threshold. Taking a look at relative performance versus our other benchmarks, the plan underperformed both the implementation benchmark and the long-term policy benchmark for the quarter as risk assets performed well. Underperformed the 1 year by 2.3% versus the implementation benchmark, again, due to the strong equity markets last year, but still showing strong relative performance versus the benchmark for longer time periods. Trailed the long-term policy benchmark for the 1, 3, and 5 year. But again, the longer term relative performance still remains pretty strong. Taking a look at Q1, equity markets have struggled year to date with a lot of, the same kind of issues we saw at the end of Q4 spilling into year 5. Market sentiment turned, and obviously we have this kind of Russian-Ukraine geopolitical issue that's scaring the markets a bit. S&P 500 year to date is down just about 10% from its all-time high right at the beginning of the year. Non-US markets have done quite a bit better than US markets year to date, but they're still negative by about 3 to 4%, depending on what market you're looking at. The portfolio as a whole is down close to 4% to start the year. So obviously not a great start to the year after a strong 2021, but we'll see if it settles in the coming time period. Turning to slide 11. So this is the growth of a dollar chart. Again, we show this every time. Nothing material here versus previous quarters. I guess one thing I just want to point out is this is such a long time period. This goes back to when we started having total plan returns, which was back in the mid 1997. So you can see just how much the compounding of the portfolio has taken effect over that time period. It starts at 1 and we have over 5 times that in just over a 20-year period. So you can just really see the power of compounding, and even with recessions that hit. You can see the large recession in 2008, 2009, and again we had a pretty big blip at the beginning of 2020. But you can see how just the compounding returns just continues to increase the portfolio dramatically. And we've been saying quite a bit. We hit all-time highs at the end of last year with the portfolio at 124 billion. So you can continue to see how well the portfolio does over time. Slide 12, same charts, just different time periods, showing the 5 years ending December and 10 years. This chart, we add alternatives just to kind of show the effect of that alternative allocation to the portfolio and how much value it adds. You can see in both time periods, it is adding value. And as we talked about last time, and just see again, we've seen extremely strong returns from most of those portfolios in the recent past. Specifically, private equity has had record returns in the last year and a half. So that's good to see. Good to see those type of portfolios adding value as versus kind of just investing in the public markets. Moving on to slide 13. So this is the contribution to total plan for 1 year. So this chart kind of breaks out the total plan return for 1 year ending, and it shows the contribution to that return for each asset class. So on the right-hand side, you can see the return 9.7% for the total portfolio, and that equates to about $11.6 billion in earnings for the year. And you can see really what's driven those returns. So you can see the returns and the earnings are driven mainly by public equity, which had a strong return of about 14.5% last year, added about 5.9 billion in net earnings. Then you can see alternatives as a whole added about 6.2 billion, with about half of that coming from private equity, which, as I mentioned, had extremely strong returns last year, had about 48% return for the 1 year ending December. So extremely strong returns, which added a good amount of value to the portfolio. Moving on to the return attribution on slide 14. So this is ending 1 year. You can see that the portfolio underperformed the implementation benchmark by about 2.3%. On the top right, you can see the breakout of that. The majority of that, again, was due to the allocation effect with a more conservative allocation than our policy benchmark, which drove about 1.9% of that underperformance. Selection effect was challenged as well last year, where we underperformed by about 40 bips versus the implementation benchmark. A lot of that came from public equity, as you can see on the bottom right here. But I just want to point out that public equity had an extremely strong several years in a row, ending 2020, and had outperformed significantly. So it's not a real surprise that it came back a little bit. And you'll see on the next chart that over the 3 year and over a longer time period, public equities added a tremendous amount of value to the portfolio. But not a real surprise to see, given it outperformed significantly in the previous years, that it came back a little bit last year. So, looking at the 3 year chart, as I mentioned, total portfolio underperformed by about 1%. The majority of that is the allocation effect, and selection effect has been strong. You can see the majority of the benchmarks on the majority of the asset classes, on the bottom right hand part of this show a positive allocation effect, with public equity having the strongest allocation or selection effect, followed by private equity. Similar story for the 5 year in the next chart. Again, total portfolio was basically flat versus the benchmark for the 5 year. And the majority of the outperformance there was due to selection effect, and the underperformance due to the allocation effect. But similar story there, strong selection effect from the asset classes, but the underweight to public equity and the overweight to cash has hurt the portfolio from that perspective. Moving on to slide 17. This shows several different risk metrics. To point out the top left hand corner, the rolling volatility, you can see that come down significantly for all time periods. The blue is the rolling 1 year, the orange is the 3 year, and the gray is the 5 year. You can see at the tail end now, we've seen a lot of the volatility in the market and in the portfolio come down significantly since that large spike that we saw in 2020. And even though we did see some volatility intra-month really in Q4, these are monthly numbers, and overall monthly it was fairly flat, and there wasn't a lot of volatility when you measure it from that perspective. Similar story in the tracking area. You see that spiked up significantly in 2020, specifically the first half of 2020. But we've seen that come down pretty dramatically as volatility in the markets itself has come down. Looking at slide 18, not a lot to talk about here, as we didn't really have any large drawdowns in the last quarter, really. A little bit in November, but similar stories we talked about in the past. The portfolio is positioned to do very well in downside scenarios, and we generally outperform significantly both the market and our benchmark, both our benchmarks in downside scenarios. You can see that in different periods of time throughout the life of the portfolio. That it's how we've been positioned pretty much. We've been conservative pretty much the entire life of the portfolio, but certainly been a little bit more conservative in recent years. But it certainly serves the portfolio well during downside scenarios. Looking at slide 19, the universe comparison. No large changes here from previous quarters. We talk about this every time. Our portfolio is positioned a lot more conservatively than our peers. So in down markets, we perform well. When markets are up, we typically lag peers. So you can see that here. We've lagged peers in pretty much every time period in terms of the returns. But on the bottom part of this chart, you can see the risk, and we're typically one of the lowest risk portfolios versus our peers. And again, we'll obviously dig into the allocation piece of this in the next segment with Callan here. But it's useful to compare yourself to peers, but one thing to keep in mind is, we're not like any of our peers. We have our own situation, and our peers have their own situation. So, it's only so useful in my mind. I mean, it's good to see what other peers are doing, but we have to determine what's best for the portfolio for us, and based on our liabilities, based on our benefit structure, based on the policy that the General Assembly set and has been able to fund us over time. So you take a look at this, but we really have to just compare ourselves to what is appropriate for our portfolio and for the beneficiaries of this plan. So
Just a question. So we're on the 3-year, we're in the 94th percentile on risk.
yes,
And that's 100 is the ceiling.
hundreds of lowest risk. Yeah. So
100 is the ceiling. I mean, okay, yeah.
yeah,
One would be the lowest.
no, the first percentile will be the highest risk. The 100th percentile will be the lowest risk. So we're among the lowest. I guess if we were the lowest, we'd be at the 100th percentile. So we are probably.
And then on performance,
We're in the 88th percentile, which
when
is.
the average person looks at this, they got to kind of flip their mind about their thinking.
Yeah, I guess it depends on. Yeah, we try to put that in the kind of the labeling there, where for the returns, the 1 is the highest performance. For the risk, the 1 is the highest risk. So ideally, right, you'd be high in performance and low in risk, but that's tough to do.
Right.
So in this situation, we're on the lower side in risk, or on both really, on returns, and then one of the lowest in risk.
Okay. Yeah, I think you get consistency here with the approach, and the return is what you would expect. I guess it would be more concerning if you saw a scenario where you were highest risk but lowest return.
Right.
In this case, the numbers here would be consistent with what you would think. If you're taking less risk, you're going to expect less return.
Okay, thank you.
Slide 20, again, is the same universe, my Mellon universe of funds, public funds greater than 20 billion. This is just Sharpe ratio, it's a measure of risk adjusted return. So it takes both into account, the risk and the return of the portfolio. And we've typically looked very strong here, really given our low risk profile. You can see in the 1 year, given the market was pretty much straight up in 2021, we look pretty challenged on this. But over longer time periods, you can see we're typically pretty close or above the top quartile in most time periods.
For most of the last 30 years, we've been to the top left.
Yes. Yep.
Of these 4 quadrants, we've stayed in this neighborhood for a long time.
Yep. Yeah. Yeah. Like I mentioned, it's we really only have 20 something years worth of data, but yes, it's I would have expected that even 30 years ago.
I just want to record John Arella is on the line, so.
Okay.
Record that. Thank you.
Moving on to the next slide, slide 21. So this is the liquidity profile. We show this every time. Not much changes quarter to quarter on this. It just shows for the total portfolio and for each asset class, really the liquidity profile of that, with the level 1 liquidity being the most liquid. Basically, we can exit the majority of the assets within 3 days. And then going to the yellow is the least liquid, which would take typically greater than 2 years to liquidate. So by policy, we try to have at least 70% in level 1 liquidity, currently at about 76%, so well within that. And as you would expect, most of the illiquid stuff is more on the private type markets, and some of the asset classes like inflation sensitive and opportunistic fixed have kind of a mixture of the two. I'm going to slide 22. Benefit payments. So these are the net benefit payments we've paid out of the portfolio. Again, net benefit payments. So it's net of all contributions that have come in. So you can see that that's trended down slightly in the last several years. We've talked about that a little bit before. It has to do with the funding policy, and that we have this ECRIS policy, which we'll go into a little bit, I guess, in the next presentation. But it allows for a little bit more pre-funding of the portfolio, which allows for, at least in the recent past, less net benefits coming out of the investment portfolio, which obviously benefits over time. As more money remains in the portfolio, it can grow quicker and can grow larger over time. So that orange solid line there, that's our annual payment percentage. So that's essentially the net benefit payment divided by the total market value. You've seen that dramatically drop as, like I said, the benefit payments themselves have dropped slightly over time, but we've seen the assets of the portfolio grow significantly over the last several years. So, I think when the treasurer started, it was at around 90 billion in 2017, and now it's, right around 120 billion. So the assets have grown $30 billion in the last 5 years, where you can see that, benefit payments are still over 2 billion a year, slightly decreased, but what really drives that orange solid line is the growth of the assets at the portfolio level. So, we have a monitoring threshold of 3% for that. So we want to, to the extent we have any control over it, which, we like to see that being below 3%. So you can see that that's significantly below that now at about 1.8%. So it's the lowest we've seen really since we've been tracking this, and at least in the past 15 years, it's the lowest we've seen that, which again is, from a liquidity perspective, it is an extremely strong position for the portfolio to be in. So that's good to see as well.
Let me add to ECRIS. E stands for extra. And so a lot of credit goes not only to the investment management team, but Sam Watson and others who have talked to the appropriators of the General Assembly, as well as the League of Municipalities and the County Commissioner Association, regarding the need to do this. This graph would look, if ECRIS were not in there, this graph 22 would look radically different right now. The E stands for extra money they put in. So as we talk about COLAs and bonuses and things, it's just important also to clarify for anybody who's listening. When the General Assembly pays out a bonus or grants a bonus or a supplement to its retirees for the teasers enrollees, that money comes from the general fund, not from this fund. When the elders approves anything, which we just did, that money has to come out of the fund. And part of the E for the elders goes to County Commissioner Association, League of Municipalities, with an agreement that was set up with them 4 or 5 years ago about how much they'd be willing to fund this plan in order to get it back up to a 90% above funding level. So people, for their own purposes, twist all this out of proportion, but they can't. These are facts that are represented, and that's what E stands for. Page 22 would look dramatically different if the General Assembly had not been putting extra money in the plan, and cities and counties had not been putting extra money in the plan for the last 5 years.
As a teaser to our next section with Cal and ALM, we'll see some interesting data on the positive impact of the ECRIS.
Teachers is,
Was that a pun? Teaser?
Unintended.
Turning to the slide 23. So again, this is the liquidity profile for the alternatives portfolios. So we combine them all together just to give you a sense of kind of what we're seeing from a cash flow perspective for these less liquid asset classes. And I'll just point out kind of the top right there, you can see that the total alternatives and the net amount we received in last year was about 3.3 billion. So we continue to see a lot of realizations really across the board in our alternatives, and we continue to see a lot of cash flow coming back. And we expect to continue to receive cash flows pretty significantly this year as well. But we did get a net 3.3 billion back from our investments from all of our alternative type managers. And then the last slide I'll hit quickly is kind of this is the valuation lag profile. We've talked about how portfolio gets valued, and some of the assets aren't valued on a real-time basis. Some of them are valued on a monthly or quarterly basis, and some of them are on a lag. So you can see that, the majority of the portfolio is valued daily. About 76% is valued daily. And then you have about another 7% or so in the orange and gray there that are valued monthly. And then you have, about 17% that's quarterly on a lag. So about 83% of the portfolio itself is marked at least monthly. And then you have, that the remaining kind of 17% that's quarterly, and some of that's on a lag. So when you have large market fluctuations, some of those assets, you'll see the lag in the reporting and in the performance numbers as well. Then I'll turn it back over to Jeff to finish up the deck.
Okay, on slide 25, our asset class net fees performance. Looking at the 1 year, I mean, it's number one that sticks out is the staggering number of private equity at 48%. But even beyond that, all the growth assets really had strong years and double-digit returns, as well as under inflation sensitive diversifiers. We saw the inflation assets in core real estate, both with double-digit returns here. So a lot of strong numbers across all the asset classes. And what was challenged there obviously was fixed income. We talked about in the opening statements, the increase in rates we saw. So that's consistent. We would think that fixed would be challenges as rates rise. The other number on the far right, Chris touched on it a little bit, but on the bottom far right, we talked about that total plan number at 688 above the actuarial return. I would say as we move to our next section, that's great to talk about and celebrate where that is. But for the next exercise, we talk about ALM. This really doesn't matter anymore. Other really fixes the starting point. But the returns we've had over the 20 years there, really aren't reflective. We kind of start with what the expected returns are going forward, over the next 20 plus years. So we'll kind of switch gears a little bit when we move to that part. On slide 26, nothing really notable other than the thing that stuck out on here was the top number, the private equity number we referenced. That's 20% higher than the highest of any asset class in any of those time periods. So just how remarkable that year was for that asset class. Other than that, as we talked about, really the growth assets were up top, on that chart as you would expect given the environment. On slide 27, our new incremental and unfunded commitments. On the far left, we only had one new item here for the quarter, which was LBA. I don't know if you want to make any just brief summary comment on that strategy or anything.
Just a continuation of our strong relationship with LBA for an industrial separate account.
And then on the far right, any changes we've had there on unfunded, I'll tell you as a reference point, when we sat down for the last meeting, that total number was right at 6 billion. So it's down slightly, down 150 roughly from there. Most of that decline is from the unfunded and private equities, pretty much most of that drop. So no real material changes other than that one item. How does that translate into history for private asset classes on the next slide? You can see where we are. So the yellow line is our total uncalled, and the darker line there is uncalled as a percentage of market value, which I think is a better representation over time because the absolute amount obviously changes a lot over this long time period. But you can see we're down to 4.7% there, unfunded as a percentage of total market value. The number was 495. We sat down last time, so we're still at a pretty or extremely low level, really, as far as unfunded goes relative to the asset size. Nothing materially comment on slide 29 on the allocation history. That's been pretty static quarter to quarter. On slide 30, exit investments, we have nothing new on that slide as well. And then moving on lastly to slide 31, which has our top 20 managers. Okay, so no name changes as a whole on this list of 20. All the names are still the same, some slight shuffling depending on market values. I would say the top two items, which represents our internally managed assets, that number is up slightly, 53.7 versus 53 before, really due to growth in equity in that piece. And then as a whole, these numbers represent roughly, I think we were 87.1% for the cumulative number for those 20. So no material changes there other than what was driven by really market changes with the internal assets. That's it for the performance recap, and let's see if you have any questions.
Questions from the committee? Thank you. Great job. We'll now go into our asset liability study with the account team. Let's get a table over there. Put that in and roll it over there. Yeah, it'll roll. Yep. There you go. There you go. That's perfect.
Morning, everyone. Good to see y'all again. So this is the second part of our study. If y'all recall, we came out, late last year and walked through some of the underpinnings of the analysis. It was looking at, for example, expected return forecasts for the major asset classes over 10-year and 30-year horizons. And Jason shares a preliminary analysis on the asset liability side, like funded ratio projections. So today is kind of where the rubber hits the road, in the sense that what we're going to do is we're going to evaluate the implications for several different candidate asset allocation mixes, which I'm going to describe shortly, and walk through the implications. Jason's going to walk through the implications of those in terms of expected funded status, expected contributions, as well as what might happen on the downside. Okay, so just a level set again, the type order message when we think about the expected returns, that over 10-year horizon, we're projecting for equities to be relatively modest performers, again, kind of calibrated off current starting valuations. And kind of linking back to what Jeff's comment was, we have to kind of play the hand we're dealt and look at what's going forward. So relatively modest expectation on the equity side. And as we all know, on the fixed income side, we're still pretty close to historically low interest rates. So that's going to be challenged as well. And you'll see that play out in the forecast we present in a second. Okay, so with that kind of preamble, let me just jump into the meat of it here. That I'm going to spend a few minutes just walk through the different asset mixes we're going to evaluate, make sure everybody's on board in terms of what we look at. And then again, Jason's going to get into the meat of it in terms of the allocations.
Just indicate which slide you're going to.
Yeah, so we're going to carry on straight all the way to 13. Okay.
Yeah, the rest of those first 12 slides were pretty much what we covered last time. So just we wanted to leave some background in there, but didn't want to spend a lot of time on it since we already discussed it.
That's it. Thanks, Chris. Okay, so in terms of devising the mixes, we've partnered with staff. We've iterated these things, bounced these things back and forth, and kind of at a high level in terms of the themes we want to look at is let's kind of turn that risk controlled dial in a sense. Let's change the relative allocation to equities versus more defensive assets. Let's create a very conservative mix. Let's create a very aggressive mix. And in that case, let's leave all the same and just kind of turn that dial. So we're going to take a look at that. Also, as y'all recognize that Your alternatives are 29% right now by policy. There's North Carolina statutes prohibit you going above 35%. So let's look at incrementally increasing those allocations to alternatives, again, with the intention of hopefully improving the return per unit of risk for those mixes. So we're going to take a look at that. And then lastly, North Carolina staff that came to us with, hey, let's just look at some incremental tweaks vis-a-vis the target policy, okay? And so we're going to take a look at that as well. Okay, so those are the themes. And now we'll get into kind of the meat of it in terms of the mix we're looking at. And again, I just want to make sure everybody's on board in terms of what we're looking at here. Okay, so we're going to look at we're going to look at the actual implementation. Okay, and so that essentially that differs from the target allocation in the sense that you'll have roughly 11% in cash, whereas the target has 1%, right? So we're going to look at those two things, and then we're going to look at these 5 mixes as I've described here. Okay, so let's go ahead and carry on to the next slide. Again, there's a lot of data on the page here, but again, just want to convey at a high level kind of the intuition in terms of why we've designed these different mixes in conjunction with that. Okay, so let's first look at the target. Okay, so I'm at the top part of the page here, right? And you can see in bold, there's kind of functional groupings in terms of how North Carolina buckets their asset classes, right? So there's growth, right? So the intent there is obviously to confer return over time. There's the rates of liquidity, which is a more defensive bucket, inflation sensitive and diversifiers, kind of self-explanatory. But so looking at the growth, right, you can see that the growth is, again, 58% at a high level in terms of growth. The rates of liquidity is 29%. And importantly, when you drill down in the rates of liquidity, right, you can see the cash is only 1% there. Okay, so if we look at the overall portfolio expected risk and return characteristics, okay, and now I'm in the middle of the table, let's just focus on the 10-year return for now. You can see that the target expected return for the current mix is about 5.8%. And again, stands to reasons given what I was mentioning upstream, compromise returns for equities, fixed income over the kind of the medium term that plays out there. And then if you look at the risk, standard deviation at about 11% from the current target. Okay, so contrasting that with the actual, again, the main thing that's driving the difference between the target and the actual is the 11% allocation to cash. You can see the implications of that are kind of consistent with what your intuition would be, right? That if you add more cash, you're going to reduce the risk of the portfolio. You see that manifest in the lower standard deviation, but also you're going to lower the expected return of the portfolio over time. Okay.
So I just want to reiterate kind of what John was saying.
Yeah.
Sorry, John. Just to make sure everybody understands kind of that 10-year expected return, you'll see it in any of these mixes. None of them are expected to hit the 6.5% actuarial rate of return. And pretty much every mix we ran, these are the subset of mixes that we ran. We ran a lot more than that total, but every one over the next 10 years, you see this more muted type return environment given where rates are now and given where the starting point is, as Jeff mentioned earlier. So I just want to make sure that's clear, is that, even if we really try to dial up the risk significantly, like mix 5, you're still south of that 6.5% actual rate of return over the next 10 years. So it's going to be a challenging environment regardless of kind of where we end up.
So Jeff, just to kind of get a level set on that, because this is a lot of information. So when you make that comment, you're suggesting that we look at these columns vertically, like, growth, global equity, look at the expected returns, and then look at a mix, and then look at the total. And so what you're saying is that in every one of those categories, it's going to be hard to hit 6.5%.
Not each individual. Some of the asset classes are expected to, but when you build the portfolio as a whole, right? So public equity itself is expected to earn more than 6.5, I believe, and private equity as well. But when you build in the rest of the portfolio, especially, fixed income returns are going to be pretty muted given where we're starting. And that just feeds into kind of the building blocks of the rest of the capital market assumptions, as kind of discussed a little bit last time. So yeah, I mean, on the whole, when you're building a portfolio, unless you really go straight for the risk assets, it's going to be real difficult to do this or to hit that 6.5% over the, really the next 10 years.
Yeah. So to your point, Chris, that you got a portfolio which is 100% public equity, that we're projecting the return of that would be a hair over 7% a year, right? And you're trying to get 6.5 over the entire portfolio. And obviously a portfolio with that much equity would be imprudent from a risk perspective.
Right. Yeah, you'd be taking on an enormous amount of risk.
I think where that concept comes through is when you put a sampling of dialing things up and down. So like in mix 5, where you see the growth assets really jacked up there, that's where you're going to see the data on what does that mean from a funding volatility, contribution volatility. You get that'll flow through on why you can't just do that.
And to Jeff's point, as I've said repeatedly, for the 40 years of this plan's life, it's about risk and return. And it still is about risk return, but it's also about the risk of the funders not being able to fund it. And I can tell you that the local governments, some of them are really struggling to pay our bill. I see the bills and I see not paying them. And so it's something that has to be taken into account, that you can't just ignore it and act like it doesn't exist. It does exist because our local governments, generally speaking, and Lawrence would second this, can only have one place to go to raise the money to pay our bill, and that's property taxes, which is disproportionately hurtful to lower and fixed income people.
Okay. So let's jump to the next page, page 15. This will be the last part of the asset section, so I'll turn it over to Jason. But this is a visualization, of the risk return trade-off for those different asset mixes. Okay, and just to orient you guys, what we're looking at on the vertical axis is the expected return over a 10-year horizon, and then we have the risk on the horizontal axis, right? And so as you expect, you see a trade-off, right? That as you move the most conservative mix, remember that was mix 1, that has 40% essentially in fixed income. So that has the lowest expected return and the lowest expected risk. And then if you go all the way to the other end of the spectrum, you got mix 5, and mix 5 only has 20% in essentially fixed income and cash. So it's the most aggressive. It has the highest expected return, the highest risk. Okay, so you can kind of think of those two bookends. And then what we've done with the other 3 mixes is look at mixes which are pretty consistent in terms of their risk return characteristics with y'all's target policy right now. Okay, so let's look at the target policy. And so what mix 8 is that's increasing the alternatives at 3%. So you go from 29 to 32. So that is to increase the return per unit of risk incrementally. You can see how you're you always want to go to the northwest on these things, right? Because that means higher return and lower risk. You can see some of that impact there going to mix 8. And then the last 2 mixes, mix 12 and mix 16 respectively. All that's going on there is we're starting with the target. And so for mix, and remember the target has 1% cash allocation. So in mix 14, we're rounding 4% to cash for a total of 5, and we're funding it from fixed income. So there you can see there's a small incremental decrease in return because now you have more cash. Whereas if you go to mix 16, now you're taking that 4% of cash, you're funding it from equity. So that means you're dialing down materially both the risk and the return. Okay, so these are the 5 mixes that we're looking at. And again, actually, I neglected to mention, you can also see the projection for the actual, right? So the actual, again, by construction, what's going on is taking the target and adding 10% to cash. So what that's going to mean is it's going to dial down the risk of the portfolio, and it's also going to dial down the expected return of the portfolio. So let me pause there because, again, this is the basis for everything Jason's going to talk about downstream. So we'll make sure everybody kind of gets the intuition and the behavior of the mix.
All right, thank you, John. I'll take it from here. I'm going to speak for about the next 35 minutes. There is a lot of material to cover. There's about 50 pages after this, starting from about 16. But what I'm going to do is I just want to highlight the big takeaways and contrast the mixes. The goal of going through all this material right now is just to, with those big mixes we're bringing forward, what looks like a suitable choice based on looking at projections of fund status, contributions, both in the expected case and the worst case. So I will be jumping pages. I might jump like 5 or 10 pages at a time just to hit high points. But obviously willing to entertain any questions and go in a different direction, depending on interest. So starting on 17, just to set the stage, we have a unique collaboration with your plan actuary, Kavanaugh McDonald. They price the liability. We employ the same software as them, so it was a really good synergy where we could use some of their code, where they're the liability pricing experts, and we took over and did the asset modeling. So John spoke a lot about capital market assumptions last year and a lot about the mixes today. All that portfolio construction, capital market assumptions is Cowan. And then we also, of course, coded the funding policy, which is very important for North Carolina. We did only model the teacher's plan, which is the largest plan. This is a good representation of all the assets and liabilities. So the Elgers is not in here, but it's a similar plan. So an asset allocation you got for the T-Series would be appropriate for the other plan as well. So getting back to that funding policy, as you know, you have the employer contribution rate stabilization policy, or ECRISP, and this is in force until 2027. It has a unique kind of impact on the plan, which we'll go through right away. And after that 2027, it expires, and then we go to the a different type of funding, financing of the plan, where each emerging gain and loss is amortized over a closed 12-year amortization. Okay, so that's your current policy. We're reflecting that, and the employer rate can never go below the employee rate, which is 6%. So that's all captured in the modeling.
Let's don't gloss over that. So you said, once the ECRISP expires.
Yep.
That was entered into before I got here. But once that expires, then you were saying the gains and losses will be what?
Amortized over 12 years, each year. So each year there's either a gain or a loss, and that's amortized over 12 years. And so it happens to get multiple layers of bases.
Right.
And the ECRISP, as we'll soon see, it puts a floor in place for the employer rate.
Sure.
There's still downside risk where the employer rate can go really high, but it puts a lot of money in it. And once we move to this once that expires, you get more contribution volatility.
So does that make it more concentrated, the losses and gains, or more? Is that 12 years is conservative or liberal in your world?
12 years is relative to other public funds is an accelerated way of recognizing gains and losses. A lot of times you see 20 years and sometimes even 30, but 15 to 20 is more common. Okay. So 12 is a conservative way, I guess you'd say.
Right. Thanks.
So our data is a couple of years old. We know but we want to capture some really good performance that's transpired. 2020, an investment return of 11.1, 2021, an investment return of 9.7, well in excess of the old 7% discount rate hurdle and in excess of the new 6.5% bogey that you have now. So that's great news. That means that if we capture that information, all our simulations, over thousands of scenarios, will start at the beginning of this year. So you can see on the right column there that the funded status that we've estimated at the beginning of this year is 95%.
That's the market value funded status. Right?
Based on
so
market
make sure that that's clear, because
yeah,
what you hear from the actuary and in the other board of trustees meeting is they typically just look at the actuarial.
Yeah, thanks for that
I
clarification.
just want to make sure that that's clear, that there is a delineation between the two.
Yeah.
You can see the differences here.
Yeah. So
What's the
90%
value to the public for even saying what's the value to the public for even talking about the market funded status if it has the potential of confusing?
Yeah, well,
It's not an unfriendly question.
No, I know. I mean, the actual funded status is what you're used to talking about when we report. That's what's driving the contributions, so it's very important. We tend to, Callan, as an investment consultant, we tend to focus on the market value funded status just because it's the economic reality of where the plan is right now. And we're looking at liquidity issues, and we just want to have a measure of market value that's consistent with return risk and everything. So, but yeah, actual funded status is a very common measure that's used for most public funds. And what it's doing is just smoothing out gains and losses. So it's lower right now because you've enjoyed a lot of investment gains. So those gains haven't been recognized yet, but they will slowly over time. And so we're just saying, you got all these gains, we're just showing it's 95%.
So using the lower one is more conservative also.
Well, it depends on what's transpired. So if you had a bunch of losses, then the actual funded status would be higher because you're holding on the losses, not recognizing those losses. So it's smoothing things out.
Quickly, if we go back to the amortization,
Yeah.
I'm wrapping my head around that. If we were to amortize over 20 years, that would have the effect of bringing the funding percentage up. Because are those two linked together?
Well, the amortization is when that starts to kick in. Well, back up 1 second, because there is actually amortization going on right now, because the actuary calculates the ADEC, which is the actually determined employer contribution.
Right.
There's a bunch of bases in there now, but that's compared to a floor, which is the current rate plus 35 bips. It doesn't impact the initial funded status. I mean, you have a gain or loss, and and that's the actual funded status is the best measure of that because it's what's recognized to date. And then that amortization will recognize that over time. So 12 years is, if you recognize over 12 years, that's pretty quick. If you recognize over 20 years, it's a lot longer. It'll just take longer to recognize the loss and gain. And it's not necessarily conservative, right? Because it could be gains that you're stretching out over 20 years. So but it will be more volatile, shorter than amortization period.
Okay, thank you.
And, okay, so I'm gonna, yes, sir.
I'd like to ask you one question. Does anybody have any idea what the actuarial funded value is for Social Security?
Yeah, they don't smooth assets. Yeah, I don't know. You know.
No, I thought the answer would be no.
Not much.
It would be a lot less than 90%.
Yeah, it would be. Yeah, they don't pre-fund.
Right.
Starting to worry about that. Don't worry,
Somebody should.
I'm a year out, so.
I'll keep on working, so your check keeps coming in.
Okay.
Bless your heart.
All right, so moving forward, so I'm going to jump to 24. And some of those pages I've glossed over where we're just showing the target through time, assets through time, liabilities. We saw some of that stuff last year. And for the sake of brevity and getting through all this material, I'm just going to jump around and hit high points. And 24 is the crisp. This is what we were just talking about. There's this floor of a current year rate plus 35 bips. But if the actuary calculates a contribution and say there's really bad board investment performance, and there hasn't lately, but if there was, that would be higher than even the floor. So what you see in the graph here, yellow dotted line, is that there's an employer contribution rate that's around 15.8, and it's ratcheting up to 18 over the next 5 years. Now, there are scenarios where it can get a lot worse than that. So again, the actuary is calculating those amortization bases and losses. And so there was a lot of interest in what are these scenarios that could cause these worst case scenarios. And we'll mention what those worst case scenarios are. There's a blue and an orange dash line, which represents the 97.5th and the 95th percentile. We define those as worst case scenarios because they're in the tail of the distribution. So the way to interpret that is that if you look at the graph at calendar year 2027, look at the blue dash line, it seems to cross right around 29%. So the way to interpret that would be there's a 2.5% chance that the employer rate will be 29% or higher in calendar year 2027. So very, very high
Speak up a
rate.
little bit. In calendar year, what?
2027.
2.5%, it could be 29% or higher. Calendar year.
2027. And that's illustrated on the graph, blue dash line there.
And just for that's 29% of payroll. So if somebody makes $100,000 a year, so whoever they work for is going to be contributing $29,000.
Yeah, so person gets their $100,000 salary plus 29,000 is being contributed on their behalf to the fund. Plus they're also making 6% contribution, so they're also contributing $6,000. So it's the employee contribution rate of 6%. So we did really investigated these scenarios, and I won't go into too much detail, but if we jump to 26, just to give you a flavor as to what kind of scenario give rise to this very high employer rate, what we did is we went into the different scenarios and we pulled out 7 scenarios that resulted in a 29% employer rate in 2027. So the second column from the right there, you see the 5-year annualized return. Those are really bad numbers. Okay, so -4, -5. One of them's positive, but it's only slightly positive, 0.9. And you can see the calendar returns that get you to that result. They're highlighted in the pinkish color. And so it doesn't necessarily have to be all bad calendar years. You could have 1 or 2 really good years highlighted in green, but over the 5-year period, those are some trends. Now, this is in the tail, right? This is we're looking at the 97.5th. So this is again, 2.5% chance of occurrence or something or worse. The expectation, of course, is 50-50. It is not for this to happen, but I just wanted to point out that even with ECRISP, there's still downside risk, and there'll still be that downside risk beyond ECRISP. You can still have contribution rates up around 26 to 30%, depending on the mix you choose. And we got one slide we'll look at later where it looks at each of the candidate mixes. It looks at the worst case rate in one of the years, 8 years out from now.
So do y'all trade off on who has to present this particular slide? Draw straws or how?
James, remind me, how many simulations did you run?
2000.
2,000.
So just to put these numbers into context with our actual experience, so our worst 1-year return in the 4 years that we have experience was 2008 was down 19%. And obviously that was the great financial crisis, and equity markets were down significantly that year. And the portfolio of itself had a lot more equity exposure at that point in time as well. In terms of a 5-year annualized, we've never had a negative 5-year annualized in the history of all the data that we have. So just a little bit of context there. And again, it's important to point out that this is the 2.5% chance of occurring, right? It's not something that we would expect, but it's a severe downside, right? And that's obviously one of the things you take into consideration when you're doing this is, okay, well, what could happen? What's the worst case scenario? What could happen in these? So I just want to point that out that, could it happen? Yeah, absolutely. But, we've never had a negative 5-year annualized return. So to have a negative 5% or 4%, again, obviously there's a chance, but we haven't seen that. So.
And part of that is my direction to them and Matt, who I said, since 9/11, look at what our drawdowns have been.
And so part of what he said was this chart that they produced for me several months ago. So it's been nearly 10% drawdown, 7.5%, 6.5%, 5, a 5, a 5, 4, 0.3, and a 4. And, you know, as we all know, a 25% drawdown requires a 33% rate of return to get back to even. Not taking into account, we're sending checks out every month. It's even more than 33%. So,
Jump to page 29. Last slide in this section, looking at the target. And this is our liquidity test that we do. And you saw a metric like this earlier. Chris had presented. You know, we take the net benefits, or we're calling it net outflow, benefits less contributions, express it as a percentage of assets. If that ratio is high, the zone testing we have here is you're okay if you're up to 7. That's just anecdotal based on our experience. It's been an arbitrary cutoff line, but based on that, everything's green here across all the simulations. So the liquidity situation looks very good. And to the earlier comment there, you know, with ECRISP in force until 2027, you can see what that does to the cash flow situation, right? Because you got a floor, a lot of money coming in, and it really results in that if you look at the 50th percentile row, you can see that the ratio is around 2.22%. It might get a little bit above 3, but you know, it's very manageable liquidity needs. And once we move out of the ECRISP, you can see how the cash flow volatility widens quite a bit, because now we have a different type of funding policy. But the main takeaway here is that we don't see any liquidity pressure, anything that would preclude you from adding additional liquid investment.
Compared to other peers, other clients that you have, again, you say anything less than 7% is good, but do you see a lot of peers that are as low as us, I guess, in terms of cash flow, or are we in an extremely good scenario?
You're in a good position. A lot of it has to do with your funded status. So you're in a very strong financial position now at the beginning of the year. And then with the ECRISP putting more money in, it puts you in an even better financial position. We'll soon see that, you know, our projections of funded status are to be fully funded by 2027. And so when you have more assets and liabilities, that helps. We'll see a lot of yellow and red in the tails for other public funds, but yours is just all green.
Yeah, that was one of the surprises for me, I guess, going through this exercise. How positive of an impact that ECRISP policy actually had. Obviously knew it was there, knew it had an impact, but until you see all these numbers, it affects the plan greatly, and in a positive way, no matter how you look at it, right? You're pre-funding a little bit more, then the portfolio is just going to be in that much of a better shape in the long term. So that's one of the big takeaways for me when you're going through this.
and I presume the ECRISP was the result of just looking out in the outfield and figuring out how the great financial crisis was going to affect whether the plan was sustainable or not, right? I mean, the drawdowns during the great financial crisis probably led to some discussion about whether these plans are sustainable or not. And if we're serious about sustaining them, we got to do an ECRISP. I wasn't here, so.
Yeah, I mean, I wasn't in those conversations about you either. Sam might have. Put him under fire. He might have been in some of those conversations initially, but I mean, it makes perfect sense. Yeah, I mean, again, it's about the sustainability of the plan for the long term.
I'm happy to answer it. I missed most of the question, so.
Well, the question was, I guess, coming out of the great financial crisis when the plan lost, no fault of anyone, you know, tens of billions of dollars, that there had to be a mathematical discussion about whether we're going to be able to sustain this plan for the next generation of public service workers. And if the answer was yes, we want to sustain this plan, then we've got to do an ECRISP. Is that sort of the pattern sequence?
Yes, Sam Watts, legislative liaison for the department and former retirement policy director during the time period we were developing the ECRISP. That was precisely the issue. You know, we were looking ahead
at the, when those amortizations was going to roll off, and it was far enough into the future. We were concerned both about the near term and the longer term implications on the plan. We didn't want to get too far behind on the funding, but we also needed a way to reduce volatility of the state appropriation. So the appropriators saw that the appropriation on a normal pattern was going to decline when we really needed it to increase. And so the ECRISP was a way to recognize that we need to keep the plan sustainable. It was a vote of confidence from the legislature and the board of trustees that we were a plan that could be sustainable, where some plans may not be sustainable for the long haul. And it was a tool to effectively smooth out the appropriations. And we've subsequently modified it to be to be cognizant of the lowering of the assumed rate of return that we did, and also the direct rate smoothing, whereby we're recognizing the lowering of the assumed rate of return over 5-year periods. Each time we take a bite each year, if you will, and the ECRISP and that work together to keep us funded.
Thank you. I think, Ms. Janarella, John, I know you can hear us, but can you, John, you want to say something?
Self-muted.
He's off mute.
He's self-muted.
I believe he was self-muted.
He's self-muted.
Can you take yourself off mute if you're muted, John?
Okay. Anyway, John was on the board who voted for ECRISP, so when he could get unmuted, we'll give an opportunity. Greg, you were not here.
No, sir, I was not. I joined shortly after that.
Lawrence wasn't here. Mike wasn't here. Okay. All right. Lynn's on. Thank you. So, all right. Keep going.
Okay, let's go to page 31 and dive into the 10-year forecast and contrast mixes. And what you see is the 10-year annualized return. We have floating bars around there that capture the 5th to the 95th percentile. So it's a wide range of outcomes. And then the table below has percentile slices to help us with interpretation. And we highlighted the 50th, which is the expected case. It's a blue row. This is what we expect to happen, right? This is our expected return in the blue. And then in like that salmon color, we have two worst case scenarios, the 95th and the 97.5th. And so this is what can go wrong, right? So when we look at variables, we're going to contrast the blue to that salmon color. That's the reward risk trade-off. And you can maybe see some additional information at the bottom of the table. Here we have the probability of getting the discount rate of 6.5, that bogey return. And you can see none of the mixes are expected to do that over the next 10 years. Now, over 30 years, there are a few mixes that will. We'll look at that soon. The mixes are not in order of risk. They're kind of the evolution of how we went through portfolio construction. So maybe I'll just orient everybody a little bit before we start looking at some of the contrasting mixes. 1 to 5 are the bookends. 1 is very conservative, 5 is very aggressive. Okay. And as a reminder, we have that table in the bottom right corner to help you remember what the composition of the portfolio is.
So 1 and 5 are the bookends, not 1 and 16.
1 and 5 are the bookends.
Okay,
Yeah.
thank you. Go ahead.
Yeah. So if you're looking for the most conservative, mix 1, the actual is pretty conservative as well, but mix 1, and then the most aggressive is by far mix 5. Mix 8 is when we added alts, so it's gonna come through as pretty good diversification. Sometimes you're gonna see it have a nice risk-adjusted return. It's gonna look good relative to the target. And then 12 to 16, this was our last stage of portfolio construction as we were collaborating with staff, where we're thinking, okay, some of these mixes might be going to mix 8 might be too far. It's a lot of implementation to get there. So what are some mixes between the actual and the target?
And mix 12 and 16 are those candidates. They have a 5% cash allocation, for instance, right? 12 is funding that cash from fixed, so it's still got that pretty good growth orientation, which is nice. So it actually looks pretty good in a lot of the charts. Mix 12, 16 funds the cash from equity, so it gives up a bit of growth, and I think it doesn't quite. It might not be suitable given that it's doesn't have that higher return, but maybe it is suitable given that it's kind of a low that will come with a lower risk profile.
Just one more comment I want to make about the kind of the increasing the alts, like that mix 8 that Jason was referencing. A lot of things taken into consideration with that, but I think one of the biggest things that we need to make sure we can implement anything that we would want to roll out here in our policy. They mentioned we have a cap of 35% in alternatives as a whole, but we also have individual caps for each asset class. And staying under those, we want to make sure the policy target is far enough under that statutory cap where we can implement, right? And where, with market fluctuations, where we will basically always stay under that statutory cap, right? So that's a focus that we have. And if we get too close from a policy perspective to that, then it becomes a little bit more difficult to manage, especially with some of these more illiquid asset classes, right? Where we have less levers to pull if we get up towards that cap. And we just want to make sure we avoid really ever going over that statutory cap. So that's another thing to take into consideration, and really why we only have so much room no matter what with any of those asset classes, just because we have those individual caps. So I just want to make sure that that's clear.
I'm going to jump to 34 and look at projection of funded status 10 years out. And as a reminder, at the beginning of the year, we estimated funded status at 95. If you look at the blue row across the mixes, we see improvement. And in fact, a lot of these mixes are expected to be fully funded in 10 years. So you look at mix 5, 8, 12, 16, target, they're all over 100%, expected to be over 100. When I say expected, referring to the 50th percentile, 50-50 chance of occurrence. Now, if we had really poor capital markets over the next 10 years, we could end up in the worst case scenario, which is the 97.5th and the 95th. And that's where you see the funded status is in the low to high 60s. So obviously a painful place to be. You might see a little bit of downside protection coming from some of the more conservative mixes in that worst case scenario. So for example, if I look at, let's look at the actual mix, right? Because it's got 100% cash. Worst case scenario, let's call that the 95th. The funded status would be 67%. That might not look as that's about the same as the other mixes, but what I have to point out here is that you put less money in to get to that position. So if you look down to the 95th worst case contribution, it's 41.702 billion. Put in less money and got about the same worst case funded status as the other mixes. Whereas, mix 5 would have had to put it around 44 billion, get them. And it actually would be 66% funded. So it's hard to interpret, right? I mean, we're looking at funded status and then we see the contributions that go in. And so what we do is we aggregate those two components. We call that ultimate net cost. So that's what we're going to focus on a lot through the rest of the analysis, because it gives you a holistic picture of cost, right? It's like, what have you put into the plan, plus what do you still owe at the end of 10 years? So instead of now, but the main takeaway here is that
this is going to be a little bit of an unfriendly question. So we just talked about on page 17 using the more conservative, which is the actuarial funded status of the two. But now you're using the more aggressive thing called the MVA over AL. You're using the higher. We determined back on page 17 that I never use 95% when I'm speaking. I always use 90.
the 90th percentile.
90. No.
Actuarial.
The fund.
Oh, 90%.
Yeah. Okay. But now you're using the more aggressive thing called market value of assets over actuarial liability.
Yes, that's correct. And
so that's not.
Well, so if we want to evaluate the mixes.
Was that clear?
Yes, yeah, I'll rephrase the question. So we're using market funded status here again, right? We're focusing on that again. And we like
We
to
don't use in our vernacular.
right. And the reason we do that is because we want to assess the mixes based on how assets are really moving, how they're actually moving, right? If you actually smooth the assets, it masks the risk. So we will use market value so that we see the full volatility. Now we could do this on actual funded as well, but you'll see that because of that smoothing, it'll be harder to discern differences in the mixes.
Okay.
Yeah, it's not necessarily more conservative depending on which way the market went, right?
Right.
So
If you're smoothing gains versus losses.
right, exactly. It depends on which way it is, right? So if this was the actuarial funded status, the 5th percentile would be lower, but then the 95th percentile would be higher in terms of the actuarial funded
So the
status.
floating bars would compress.
Yeah.
I just don't want to talk out both sides.
Yeah. So yeah, we're gonna continue with the market value definition, which is a little different than reported actuarial value, because the ultimate cost will also have, when we calculate what you owe at the end of 10 years, that's based on a market value basis.
I had to stop it one more time because I talked to the funders of this thing. So it's unfair for me to show them this graph and say, based on ECRIS and this, that, and the other, that we could get to 95% fundedness, 100% fundedness in 5 years under different probabilities. Oh, that's a more, see what I'm saying? I can't go to the funders and say, you know, based on you doing what we've asked you to do, if we have a 50% chance of hitting these numbers based on this asset allocation, it'll be 100% funded in 5 years. But that's not comparing that to the number that's in their head already, which is we're 90% funded today.
Yeah, so to your point, if we were to recast this in terms of the actuarial value,
Right.
the intuition, I think you're right, is that number, it wouldn't be 5 years, it might be 6 or 7 years, right? In the expectation, Jason, in terms of hitting the 100.
No, it would be about, well, so it gets complicated. So the asset smoothing is probably 5 years.
Okay.
So when if you, at the beginning of the year, you're 90% on actuarial, I say, but the market value is 95, there's a 5% gap there, right? But that 5-year asset smoothing means that the actual value will convert to the actual market value when it stats in 5 years, once that gain gets recognized. So all else equal, if you met the 6.5% return, that 90% will converge to the market value of 95.
Okay.
And that there'll be no more gains and losses, right? Because we assumed all the assumptions were fully realized. Now, of course, that's not what's going to happen. There will be gains and losses. So but it would be 5. It would be 5 years. The being fully funded by 2027 is a good number, whether we look at actuarial or not.
Okay. It's just with the funders, it's just really important that I am consistent with what I'm telling you. So, thank you.
So I defined this new variable ultimate cost, which is what you've paid over 10 years and what you owe at the end of 10 years. And on 36, we have a graphical display of this ultimate cost. And so we have the expected ultimate cost on the vertical. So this is what your expected cost, right? So what contributions you're putting in plus what you are expected to owe in the 10 years on the vertical. And then, as it's a cost number, we want to reduce it. We want it to be low. So the axis here is inverted, because just to orient ourselves to the same type of risk reward relationship we talk about return to risk. Being in the top left is the good corner, right? We want to be top left. The horizontal is the worst case scenario defined as the 95th. This is where things go wrong. Capital markets are poor. We got, not only do we have to put a lot of money in, we still owe a lot of money in. And we now have the mixes in here, and this is in alternate cost space. But it might look familiar. This kind of is a mirror image of what John was showing earlier, like with return and risk. It's kind of what we expect. But now what we've done is we've run the funding policy, we project the assets and liabilities. Okay, what do you actually still, what do you expect to owe versus what is the worst case scenario for what you owe? And you can see, remember, the bookends. Mix 5 is the most aggressive. Yeah, it can reduce the cost the most because it's the highest position, right? But it's got the highest worst case cost, right? And then Mix 1 is on the other extreme, where it's very conservative. By running through your own funding policy and your assets liabilities, it's interesting to see that Mix 8 still comes out as pretty nice, right? It's expected to reduce cost a little bit relative to the target. That's also reduced your worst case cost. So that's hard. It's hard to get that kind of trade-off there where you look good at both dimensions. The actual is fairly conservative, but it's going to cost a bit more, right? Because you got 11% cash position. The perspective here matters. I mean, if you start yourself at the actual position and think about what other mix can I go to, Mix 16 and Mix 12, I think, are looking pretty attractive because they're reducing the cost quite a bit without a big increase in the worst case scenario. And another way to say that is we're getting more return, we're expected to reduce cost, and yet there's not a lot more downside risk to move to 12 or 16 or the target. And so we've captured, so one last slide on this is on 37, where we quantify the change in the expected ultimate cost and the change in the worst case ultimate cost, and then graphed it in this bar chart on 37. And the change is measured relative to the actual. So again, the perspective is the actual allocation. What is the cost result if I say move to Mix 12, right, on this bar chart? Well, the expectation is it's savings of around $6 billion over the next 10 years. Cost $6 billion less. Now that could be less contributions. It could be owing less at the end of 10 years. It could be a combination. But it is a little bit more risky. And so, but that additional risk is about 1 billion. So, you know, an expectation of saving 6 billion versus maybe an increased downside risk of 1 billion seems like a pretty good trade-off. Both Mix 8, 12, and I would say the target have this kind of good trade-off, in my opinion. All right, so that's the last slide in this 10-year forecast horizon. We also ran this on 30 years, but I'm not going to walk through all that information as well. It's a very similar story. The mixes have a, when you go at 39, just this is the only slide I'll touch on this section. When you look over 30 years, what happens is the aggressive mixes look a bit more compelling, right? Because if you look at a short-term horizon, volatility really matters a lot. Over 30 years, you know, you're rewarded by taking on having exposure to equities, getting equity risk premium. So it's a little bit more compelling to get aggressive if you look at the 3-year forecast horizon. But one main takeaway I just want to, from this section that I want to point out is that the probability of hitting 6.5 is higher due to the way capital market assumptions and mean reversion. We have higher returns in the back 15 than the front 15. And highlighted in green are the mixes that are expected to hit 6.5. Now, Mix 12 is not highlighted, but it's darn close. I mean, its expected return here is 6.4, and it's a 49% probability of hitting 6.5.
When you have done these for other clients in the past, I mean, do you ever focus on that 30 years? It's just such a long time, right? I mean, we typically focused on, you know, the 10.
Yeah,
and I think that's most appropriate.
The emphasis is on the 10 because it more better acknowledges the challenges of the current economy, right? The low yields, the high equity valuations. It's like how in 10 years we consider long. We consider that a long time horizon. This is still strategic planning, but it's got some current economy. right? Whereas when you look over 30 years, that's such a long period of time. It's not really relevant to where the current economic state. And that's why you see the higher returns. They're more anchored in long-term history, which is better returns than what we're seeing over the next 10. And as a result, if you just look at the 30, you might get maybe false sense of security that, oh, things will just be fine over 30, whereas big challenges in the front 10, the next 10 years, right? At least according to the capital market assumptions that we've developed with the staff that are consistent with our other assumptions that we use for our clients that are low return expectations, lowered by historical standards for everything, for equities, bonds, alternatives.
So, yeah, I mean, just succinctly, you play the hand you're dealt. So for the purposes of setting your asset allocation, we think you need to look at the 10-year number because that reflects the current market environment. But things like the 30 years very informative for the long-term health of the plans. There's kind of two different purposes, but I underscore the 10-year when we're setting the policy, that's what should be the primary focus.
Thank you.
On page 36, where you talk about less cost and higher cost, that less cost, based on what you've been presenting so far, keeps us up in that top left quartile of something we discussed.
Sorry, say that again, sir.
The graph we looked at 20, 30 minutes ago that had always had us up in the top left quartile. What you're showing us on page 36 is we hit these assumed rate of returns, we're going to stay in that risk reward.
You talking about that Sharpe ratio?
Yeah.
Chart there? Yeah, I mean, it's measuring kind of two different things, but yes, I would imagine. And it depends on, I guess, what mix you choose and how that compares to our peers, right? And what they do on those kind of charts.
Okay.
So, I think what I'll do is I'll just talk to two more slides because we're running up against the end of our time here. But I did want to just maybe touch on contributions a little bit. So on 46, we have, this is a whole section where we investigated contribution risk. And we looked at it a number of different ways, but I'm just going to highlight two slides. The first one is just what we expect the employer rate to be. When I say expect, that's synonymous with median. It's a 50-50 chance of occurrence. And you see the mixes in the line graph there. We have the ECRIS in force to 2027. So this is the expectation, right? We don't have distribution of outcomes. So we expect the employer rate to ratchet up to 18 if it expires, and the rates is expected to fall. Now, if it was a conservative mix like the actual or mix one, it's still, up around 7 to 10% for quite a few years. If you went to mix 16, it's dropped. But the other mixes are dropping pretty precipitously, hitting at that 6% minimum by about 2030, except for the actual mix one, right? So that's the expectation what happen. And then just to balance this, on last slide I'll do is 47, which is just a cross-sectional look at an employer rate where we have the expected rate on the vertical, the worst case rate on the horizontal. And this is 8 years out, so I think this is 2029. And you can see, again, our bookends orient us. Mix one is very conservative, so it's got the highest rate. The actual is similar, it's around 10%. Mix 5 is very aggressive. The expectation is the rate will be down about 6, but the downside of this is there. You can see that the mix 5 would have the highest employer rate, up around 29.5, whereas mix 1 being more conservative, protecting a little bit more, would be only 27. I mean, both those rates are really high, but some downside protection coming through the more conservative mixes. I think that's just given our time. I think I'll just stop there.
Yeah, I just want to highlight kind of this, maybe the last slide, 46. I mean, this is kind of pretty powerful, just kind of showing power of kind of what the ECRIS is doing, where it's based on the median, right, the expectations. The contribution rates decrease significantly really regardless of what mix you choose, right?
Yeah.
Now again, the downside piece is certainly different and obviously we need to take into consideration, but and it just kind of shows the power of what that ECRIS policy has done over the past years, and then obviously we'll continue to do through 2027. So that's good to see. I mean, it certainly gives us more flexibility, frankly, on the asset side, knowing that that this is in place and that the funding is. I'm assuming the funding is going to be there, General Assembly and from everything in the near term. So pretty powerful chart in my mind.
Yes, let me just add one comment to that, which is, I mean, it's a very benign picture, right, in aggregate, but I would just point out that if you look at the actual and the mix one, so the more conservative mixes, you can see they don't have that profile in the expectation where it dips down to 6 in terms of contributions. The reason that is they're just so conservative, they're not earning enough money to offset the contributions. So, I mean, that's I think a really key point. I just want to underscore that, right? Because there's a difference between being conservative in the short horizon, but then that can have implications in the long horizon.
And John or Jason, I know the treasurer was concerned about the impact on the funder, so maybe just to repeat kind of the key takeaway from this page.
Yeah, so this is the entire section where we investigate contribution risk. But this, I think, is maybe the key slide here. And what it shows is the expected employer rate across the mixes. And it's very apparent when ECRIS was in force, right? Because you can see it going from about 16 to 18, and then it expires. And now you don't have that floor anymore, and the rate is expected to drop, right? We don't have the worst case scenario in here, but it's expected to drop quite a bit. But it's interesting that with actual mix one, it doesn't hit that minimum 6% rate for a while. I mean, it's not, you don't have as much investment earnings being generated in those mixes. The other mixes are dropping to 6 pretty quickly, but you can even see mix 16 is taking a little bit longer as well. And remember, that one was where we funded a cash position from equity, so it doesn't have that strong growth orientation.
Well, I can assure you I'll need all those hundreds of billions of dollars for the state health plan by then. So I can absolutely assure you that.
I think the helpful thing at least from my perspective and going through the exercise is not that there's a wrong answer in any of the mixes, is that there's trade-offs, right? Is that when we look at more conservative mixes that are in the mixes here, what we see is that it reduces some near-term volatility, but there's a long-term cost to it. And the data helps us kind of quantify that at the end of the day on it. And then the flip side is if we earn more and take a higher risk plan, we can earn more assets, and that has a reduced, cost too, but it brings in some near-term risk and funding volatility. So there's a trade-off in those two things. Not saying one's more important than the other, but I think it helps us get the data and the numbers to say what are those different trade-offs and quantifies the amount of it. So it is a ton of data that comes at us during this process for sure. But I think that's really helpful in thinking about those different trade-offs and which ones you want to weigh as we plan on a new allocation, if there's a change.
I think we've got a couple minutes. You guys not hitting slide is 48, 49, the next couple of slides, just kind of shows one of the concerns is contribution rate volatility, right? And spikes in contribution rates in any given year. And I kind of looked at that a little bit here, and this kind of shows that. So I don't know if you can walk that through.
Sure. Yeah. So this is again a cross-sectional look at the data where we look at the employer rate change from 27 to 28. And so we calculated that change, and it could be 0, it could be 1, it could be 3% change in employer rate. And there's sensitivity to having a spike in the rate, but we want a big change. And so once we've calculated that change, we then sorted it and looked at the worst case change and show it across the mixes here. So again, to orient ourselves, the book gets how mix 5 is very aggressive. It's going to have more downside risk. And you can see the worst case change there is 3%. Whereas the actual mix 1 The worst case change is lower than that. It's around 2.4 to 2.5. So the risk of the portfolio definitely correlates with a contribution spike over 1 year. Now, what also matters though, John mentioned this just a few minutes ago, that you also, if you're going to be conservative and you manage short-term volatility and you give up upside, and your plan gets in the very, and so you give, and forgoing that, getting into that stronger financial position that some of the aggressive mixes can get into. When we looked at some of the contribution volatility later on, we saw that the conservative mixes actually had more volatility because they were just in a worse funded status to start with. So that's what's happening on 49. So here, what we're measuring is the probability that any rate change will be. And so this is, the top graph is year 8. And that is intuitive because we see the lower probability for actual mix 1, but for mix 5, we see a higher probability of triggering this, what we're defining as a spike is over 2%. But when we go to year 13 at the bottom there, and there's, this is cross-sectional look, it's not going to be always the same. Year 13, it happens to be one of the worst years. And you can see the probability of a rate spike is elevated. That's the first takeaway. The second thing is that the actual mix 1 actually have a higher probability. And when you project out for 12 years, a lot of the mixes that were pursuing a higher return, across a lot of those scenarios, they were in a stronger financial position. They were at the 6% minimum rate. And so you're not seeing a lot of spikes occurring, whereas in the actual mix 1, they're still maybe underfunded and paying a rate of 6, you're seeing actual bit more volatility. So it's counterintuitive until you think about where the plan gets to at the end of the 12 years.
Yeah, I know, looking at all these, a lot of this stuff looks like it's on the margin, right? All these mixes, it just changes slightly over here and there. And then again, it comes back to what Jeff was saying, trade-offs, right? You got to just try to determine, the best trade-off for the portfolio and how much risk do you want to take versus protecting on the downside. And the bottom line, that's kind of where it gets to. So yes, in terms of next steps, this is the end of Callan's piece of it. So we thank them for all the hard work, and they worked well with staff, and we went through a number of iterations of this and a number of looking at all this data, and it's been a lot of work on both staff and Callan, so we certainly appreciate the work that they put in, and staff, of course. So, we certainly wanted to present the different mixes we were looking at. We wanted to get any input that the IEC has. So whether it's now, or I know we're having some issues with microphones and stuff. So shortly after, and then we'll obviously sit down with the treasurer to see what changes we want to make to the current policy. And then we'll come back at the next IEC meeting with the revised investment policy statement for review.
Great.
This study was done in 2017 last, is that correct, approximately?
I think it was 16 was when it was finalized last year.
What was the projected return assumption?
It was 5.9% for the 10-year.
And we were at
And we're higher than that now.
8.35 for 10 and 9.43.
Yep.
I would guess if we looked, we were probably the top 25 percentile.
I would guess that's the case, yeah. So obviously returns have been strong. The markets have performed well the last 5 years, right? So we're definitely well ahead of that.
Right.
That also gives us our point of where are we today, right? And what are we looking out at?
And that's also an example. We were the top 25 percentile. We could also be in the bottom 75 percentile next 5 years.
Correct. Yep, absolutely. Yeah, I mean, that's why we have all these probabilities in here and try to make the best decision we can with that, because nobody really knows, right?
And
I was carrying that chart around with me in 2016, but the probabilities of hitting that number were still 50%.
Okay.
Yeah, so exactly right. Point that out. All right, John Anarella can hear us, and but we can't hear him, and we've been working on that. So I apologize, John. Loris, anything?
No, I think that this is a very meaningful study. And I am surprised at the closeness of actual to 8 and 12. They're right on top of each other. So consequently, going forward looks good. One of the things that we certainly need to be aware of is these people that, friends of mine who are retired, what they want to get is a check every month. They're not interested in increasing risk. And the highest risk is in Social Security for people who are
That's a good line.
years old.
So you guys keep working. All right. Anything else? Thank you all very much.
Thank you.
And next.
Good morning. Still have the old man face mask on here. But good morning. My name is Ron Funderburg. I'm an investment director for the inflation sensitive portfolio. It's my pleasure to present to you all twice a year, one for opportunistic fixed income and today for the inflation sensitive portfolio. And just for a second, I'd like to mention one of the more special plan participants, my mother. She turns 81 this coming Sunday. So I want to wish her a happy birthday if she's watching or listening. Today I'm going to talk to you about the inflation sensitive portfolio. And there are 5 things I want to go over. I'm going to recap the history of the inflation sensitive portfolio and what the role of it is. We're going to talk about the current portfolio construction of the portfolio. We'll talk about the performance. Fourth, we'll talk about the inflation environment that everybody's experiencing. And then 5th, we'll talk about what this all means for what we think our future investment portfolio may look like for the upcoming year. Again, the role of the inflation sensitive portfolio is 5-fold: to provide some degree of protection against inflation, provide attractive absolute returns, competitive relative returns, diversification, and liquidity when things go afoul. Next slide. This particular slide shows the diversification, the continued diversification of the inflation sensitive portfolio since its inception in December of 2010. The particular portfolio has gone through 4 phases, and we're currently in the 4th phase. And the 4th phase has a strong emphasis on diversifiers and real assets. As you can see, the green bars have expanded over time, and currently we are approximately $5.5 billion of plan assets, but we sit at 4.5%, approximately 4.5% of plan assets. And you'll also see that over time, the orange line, the publicly traded natural resources line, has continued to decrease over time. as when this portfolio was originally set up, we were 100%, pretty much 100% allocated to publicly traded commodity and Bloomberg-oriented commodities. So I believe the diversification has benefited the plan and from a number of ways. Next slide. This slide showcases our commitments and unfunded over a period of time. And as you see, since 2012, there's been continued emphasis on the other real assets and diversifiers. Appendix Page 21 is a perfect page to couple along with this particular page, as that particular page showcases the performance according to each vintage. So if you see the vintages, what we did in 2014 or 2015, 2016, you'll see what those funds have performed on a vintage by vintage basis. And you can see that since 2012, we've had a material and positive impact on performance, beating inflation for a lot of our vintages, et cetera, since we've been allocating and focusing on diversifiers and real assets and diversifying away from the publicly traded natural resources. Next slide. This particular slide showcases the balance of the portfolio. Again, we're about a third real assets and diversifiers. Currently, we're about a fourth inflation-linked bonds. Inflation-linked bonds are shorter duration bonds that where income should adjust up as rates increase or LIBOR increases or any of the things in the space increases. And then we're about 2/5 private natural resources, and we're diversified across a number of sub-strategies as listed on the right. Now I'd like to talk to you about performance. Next slide. As you can see, we've outperformed our benchmarks on a 1, 5, 7, and 10-year period. We missed the mark on the 3-year period, and a significant portion of that is due to the pandemic and things that the drawdown that occurred during the pandemic. And this past year, our benchmark performance was 10.6%, and we were able to achieve a 12% return, beating our benchmark by 140 basis points. And over the last 5 out of 6 years, we've been fortunate enough to at least meet or exceed our benchmark returns. Next slide. This particular slide breaks down the performance of our portfolio based on the various sectors. The lines going across showcase the benchmark, and the circles showcase what our portfolio has done. Or the portfolio closely matching that particular color bar. And so you see the orange publicly traded natural resources fits directly on that particular benchmark. You see our other real assets and diversifiers has performed about a 500 basis point outperformance in the last year relative to its benchmark. And then over a long period of time or further out, you see that real assets and diversifiers is positively contributing relative to the benchmark and positively contributing to the overall portfolio. Next slide. This particular slide showcases what our long-term policy benchmark is and how we're marketed currently relative to that. The orange pie slice, you can see that we're materially underweight Bloomberg Commodity Index. Not necessarily saying that we're going to change that anytime soon, but that's the biggest risk factor that I see relative to the long-term policy benchmark. However, it's been a great thing over the long period of time as we diversified out of Bloomberg Commodity Index opportunities into some of the other opportunities mentioned. I'm going to transition and talk to you a little bit about the inflation environment. This particular chart shows the dot plot. And what the dot plot is just a survey of the Fed members in terms of what they believe the overnight Fed's funds should be. And as you see, as you move from left to right, you see that the Fed funds rate is anticipated to be higher and higher each successive calendar year. And when this particular slide was put together, there was a 44% probability of 4 rate hikes in this particular calendar year. A month has changed since we put this slide together, and there's more like a 58% of at least 6 hikes. And then there's a 100% chance, or at least the market believes that there's a 100% chance that the next hike will occur in March at the next Fed meeting. And that's kind of indicative of what we all are experiencing with regards to inflation. And we believe that the Fed may step in and change its policy in order to mitigate or dampen potential negative effects of inflation. Next slide. This particular chart shows the CPI year-over-year changes and break-even rates. The break-even rates show in the near term, or the market indicates a low inflation moving forward over the next 5 years, sub 3%, and sub 3% for over a 10-year period. But in terms of the near term, there's a chance that inflation could be higher, as measured by the CPI year-over-year change. The last time that this particular slide was put together, headline inflation was 6.9%. The last recent reading, headline inflation is 7.5%. And so we see inflation picking up, and that's for a basket of goods weighted according to various things. In our own individual lives, we may see different things. If you are at the gas station, you may see a 40% increase in goods. If you're at lodging or going away, you might have seen a 20% chance in increase in prices. Veal or beef, you might have seen a 16% chance or increase in rates from January of last year to January of this year. The same for pork, et cetera. A lot of the things that we have experienced as consumers, you may experience a different number than the 7.5% mentioned here. One thing I'd like to point out is that even shelter in the number is only a 4% change in shelter, whereas home price appreciation over the last year has been north of 18, closer to 20%. So, you know, sometimes you can't allow what you see as the CPI change to be the number. You have to sometimes go on your own personal experience as to what inflation means. I'd like to move forward to the next slide. Again, the current environment is setting up potentially for inflation to be less transitory and more feeding upon itself as the labor market is relatively tight, as the quit rate is highest that it's been in several years. I think the quit rate, if you had a chart of the quit rate, I think it's moved to 3 to 5%, which is high, really high. Right around the pandemic, the quit rate was like 0. No one wanted to quit their job. But you combine a tight labor market with a higher quit rate, and you see that hourly earnings continue to increase year over year. And this is, I think a lot of people also reference what do they call it? The Great Resignation. And I think the Great Resignation is somehow playing a part in the inflation numbers that we're seeing. Next slide. Again, I mentioned housing, where we've seen home price appreciation closer to 20% over the last year. And in the bottom right corner, you see households' equity in real estate has appreciated, which kind of reflects to consumer confidence. And when consumers are confident, they're purchasing, the increased demand in items. Demand is one input into inflation, right? Supply and demand go together. But the last couple of months or last month or so, if you evaluated consumer confidence,
it's been shaken somewhat. And I think the rationale associated with it is because of inflation, what people are seeing, and potentially what the impact of inflation may be as the Fed changes policy moving forward. The last slide on the current inflation environment shows that we've had a weaker dollar since the start of the pandemic. And a significant amount of that has, in my opinion, has been driven by the increased money supply that we've seen. There's been approximately $6 trillion added to the money supply here. And a weaker dollar should actually support higher asset prices as it relates to commodities, as it relates to a lot of the other things that we see in real assets, right? What does that mean for us moving forward? Significantly, there's a lot of uncertainty moving forward, but I'm happy that we actually have an inflation-sensitive portfolio that's performing and trying to allocate to strategies that will react positively to inflation. But moving forward, what we like to do is rationalize our current manager lineup and focus on our high conviction opportunities. We'd like to maintain vintage and strategy diversification, as that has been a positive for us in the past, as highlighted previously. Additionally, and most important, we like to focus on areas where there are gaps in our portfolio, where inflation could hurt us, and where we like to close those gaps. And then also we like to add in sectors and strategies where there are attractive valuations. As Warren Buffett would say, the first rule of investing is to remember not to lose money, and the second rule of investing is not to forget the first one. So we want to invest in opportunities where we have the highest chance of making money, where attractive valuations are pretty attractive. And we also want to invest in areas where there's strong industry tailwinds, where supply demand imbalances may be imbalanced for the long term, or at least in our favor as investors. What does that look like as we move to the very last slide? In the energy space, there's been reduced CapEx over the last couple of years, and that may actually reduce the amount of supply of energy in the space. And as the economy recovers, demand may continue to be strong. And in the technology and data space, we know that there's a significant demand for technology data infrastructure, et cetera, as the world continues to move online. And so there's an area where we might see some investments there. We may continue to see investments in other areas, whether or not it's real estate, healthcare. We know from our personal experience that costs are increasing and that there's an aging population. And so we might be able to benefit from the tailwinds associated with some of these spaces. And that brings me to the conclusion of our conversation and review of the inflation-sensitive portfolio. Okay. Questions?
Hey, can you all hear me? It's John Anarella.
Yes, sir.
Oh, thank you. Hey, Ron, you want to touch on lumber?
Yeah, lumber futures are up, and that's driven significantly by the demand in housing. It's driven by a number of things as well, but we definitely continue to see lumber prices going up, and hopefully we will continue to see that impact pricing for timber and various portfolios that we have. Any particular aspect of lumber you want me to address?
Well, I was just thinking if we were getting any of the liquidity from that big asset we have.
Yeah, I'd say the environment has been really strong for us in that area. We've had a lot of inbound inquiries with regards to several of our properties across the board. Additionally, our managers have generated about $4 million more in operating income than they expected over the 2021 calendar year. One particular manager forecasted probably earning $16 million in operating just by selling our timber to local mills. and they generated $4 million in advance, higher than that. But at the same time, they actually cut a lot less timber on some of our properties. So that bodes well for our valuations in the future if we were to ever sell any of these properties. And again, one reason for holding timberland is to benefit in an inflationary environment. And I'd say that most recently we are benefiting in the timber space from holding these assets as we see increased demand for our timberland and increased demand for our timber, cut timber. So don't necessarily know what the future holds for that, but we are definitely benefiting from the current environment right now.
Okay. Thank you.
John, this is the treasurer. Obviously, this has been a frustration for this plan. This lack of performance out of this asset has cost the plan over 16 years, well over $1 billion. Is that accurate?
It depends on how you define what opportunity cost is, but yeah, my team's not excited about the historical performance of the timberland portfolio. However, we are managing it and excited about the prospects.
We're trying to take advantage of some of this, and there's a great point you made, John, about the difference between lumber prices and timber prices. Other than the fact they both have wood in them, they couldn't be more different as far as what we're seeing. We need to have some hits here, whether it's in the northwest with our Oregon and Washington properties, or Little Rock with their economic development site, or some of the Mississippi properties. There's a lot of swirl around that, and the biggest fear on this portfolio now is that as patient as we've been, that we sell at the wrong time. That's the biggest risk, and so we're in constant contact about it, and we get agreements to purchase, and then the deals fall through, and so it's a $1 billion investment, and they really hadn't done anything in 16 years, so people could do their own math. But we're in close contact with Ron and the property managers, and would like to see something happen. So if anybody wants to buy Cross City, Florida, we'll sell it to them. So it's 119,000 acres. So maybe the four of y'all can get together at lunch.
I don't know if those four can pull that one together, because Cross City is a very valuable property. That thing is super valuable. So no low ball offers there.
So anyway, a lot going on there. Thank you, John. Greg or Lars?
No, sir, nothing else. Thank you, Ron. Very good report.
Oh, thank you. Anytime. Shout out to one of my special plan participants, Janie W. Funderburg, who's turning 81 this particular time.
Is she listening?
Say it again.
Is she listening?
She's gonna listen. She's gonna listen.
Go ahead, Ron. Let's lead her in happy birthday.
I will do that.
Go ahead.
Happy birthday to you. Happy birthday to you. Happy birthday, dear mama. Happy birthday to you. Thank you, Treasurer.
All right. Any question? We'll go right to the public comment section. We have 3 people sign up for public comment. I think the participants are very familiar with the rules. Ken will be the timekeeper with 3 minutes. And we'll start with John DeVille. John, can you hear us?
I can.
You have the floor, sir.
Treasurer Falwell, my name is John DeVille. I'm a teacher here in Macon County. Last session, you ignored a question that I asked, which I expected because you've ignored a year's worth of questions from teachers like myself across the state. Educators have asked you, and we would like to know the following. How much money in total dollars has asset allocation choices, namely holding $20 billion in cash, how much does that cost those of us who are teachers and those of us in law enforcement who protect and serve? Second part, how much funded status in percentage point terms have we lost because of these missed opportunities? Third, did professional staff recommend redeeming these investments now held in cash, or did you do that of your own mind? Did you do that unilaterally? Fourth, did you accept or reject recommendations from professional staff about the use of proceeds from these redemptions? Fifth, how much of the total fee savings that you highlight comes from not investing our retirement savings as opposed to getting a better deal on investments? Do you expect educators are going to need to work longer? Am I going to have to go past 30 years before we can retire? Is this a goal, or is this a plan to save fees by sitting on cash? How large of a lifetime cost of living increase could the returns that you gave up, how much of that could have been provided to retirees in a COLA? And then finally, why should county commissioners and school boards have to make up the cost of lowering your own investment standards? Thank you very much, Treasurer Falwell.
Thank you, John. Our next is Melissa Chang.
Good morning, Chair and members of the committee. My name is Melissa Chang, and I'm with the Private Equity Stakeholder Project. North Carolina is an investor with private equity and real estate secondary firm Landmark Partners, a subsidiary of Ares Management. Specifically, North Carolina is an investor in Landmark Real Estate Fund 8, which invested in Pretium Partners. Pretium Partners and Ares Management are also joint owners of Front Yard Residential and Havenbrook Homes. Landmark is also invested with these two rental companies. I wanted to follow up on my November comment regarding Landmark Partners and Pretium Partners rental home investments. On February 10th, the Minnesota Attorney General filed a lawsuit against Havenbrook Homes, Front Yard Residential, and Pretium Partners, alleging that the company, quote, failed to repair and maintain homes that lacked heat, had backed up sewers, doors and windows that would not close, mold, even wild animals, and when it did, violated Minnesota's lead paint rules. The complaint also alleges that Havenbrook Homes violated the state's eviction moratorium. In a press release, the AG states that he, quote, filed this lawsuit because it's my job to protect Minnesotans from fraud and abuse, and that Havenbrook's practice of leaving tenants in uninhabitable homes isn't just shameful, it's deceptive, fraudulent, and violates Minnesota law. I'm holding them accountable for it, end quote. For months, tenants have alerted Pretium, Ares, and Landmark Partners and their investors of outstanding maintenance issues. Last September, a Landmark Partners executive even told the Alameda County Employees Retirement Association board that they and Pretium Partners were aware of at least 217 maintenance issues in Minnesota and were investigating the situation. However, Havenbrook Homes failed to resolve maintenance issues at its properties and just last month had its rental license revoked in the city of Columbia Heights, Minnesota. After maintenance issues were initially reported in July 2021, city inspectors returned to the homes monthly from August to November, reaching out to Havenbrook Homes one last time in December 2021. After 5 months, the repairs had not been completed. In a statement issued by the city of Columbia Heights, some of the violations are detailed, including missing or broken carbon monoxide detectors and smoke detectors, lack of functioning locks and latches on doors and egress windows, combustible material stored under basement stairs and near the furnace, mold in the kitchen, holes in the walls, illegal bedding in the basement, leaking plumbing, broken windows, and incorrectly installed or poorly maintained electrical wiring. As a result of Havenbrook's inaction, the 21 families renting from them in Columbia Heights were served 45-day notices to vacate. Landmark Partners is currently raising money for a new real estate fund, Landmark Real Estate Fund 9, and may come to North Carolina seeking additional capital. We believe North Carolina should hold off on new investments with Landmark Partners. We also believe that North Carolina should investigate whether these firms have engaged in similar practices here in North Carolina, as Landmark and Pretium own thousands of homes throughout North Carolina. Thank you.
Thank you. And our last participant is Isaac Higgins or Huggins. Okay. Going once.
Can you hear me?
Yes, we can. You have the floor, sir.
Thank you, sir. Good morning. My name is Isaac Higgins, and I'm a retired educator. Prices have gone way up this year. The cost of gas, food, and household items have increased across the board by at least 8% or more. And trust me when I tell you, I and my retired friends are feeling the squeeze of these rising costs. But guess what? This increased cost of living is not being reflected in my pension. Although the fact that the cost of living is not reflected in my pension isn't a surprise to you. And I'm concerned and very troubled that my lack of a cost of living increase isn't a priority to you. As such, I have a few questions. Why are you passing on this loss of real income to retirees? Is it because you don't have enough money to champion a code? Would there be enough money if we had the more than 10 billion in returns that you passed up by holding so much of our savings in cash, essentially shoving it under the mattress? What has been the cost to the public educators who protect, serve, teach, and nurture the 1,431,121 students across this state in 2,615 public school districts across North Carolina? Because you're sitting on nearly $20 billion. Did the professional staff recommend this, that you sit on nearly $20 billion? Or was this a decision made in a one-person echo chamber? How much of the total fee savings that you highlight come from not investing our retirement savings? Is your plan to sit on cash, supposedly saving fees, stop the cost of living increase that could have been provided to retirees? As a retired educator who dedicated 32 and a half years to the public schools of North Carolina, I expect and deserve more. So do the other retired educators across this state. I thank you for your time and allowing me to speak. Have a great day.
Thank you. We'll now close the public comment section. Any board members?
I know, sir, nothing else to ask or comment on.
John?
Yeah, this is John Anarella. First of all, I want to apologize. I have a new laptop and I think I have a security setting that wasn't allowing me to put the mic on. But I do want to comment on eCrisp. I know it's a little off topic at this point, but it was something that we were doing in order to ensure the financial stability of this massive retirement system, and I was very proud to vote for that. So I give credit to staff for looking forward and planning. I do, not necessarily today, but I think we really need to get a good handle on the future liability to the local governments for the pension system once the eCrisp ends. I mean, I know we saw the worst case scenario and so forth, but I think we really need to articulate that pretty well to the communities as we go forward, to see if there are going to be any changes that we're going to make. As a former mayor, I know that 33% pension liability would be pretty devastating. So anyway, I'm going to be there next time because it's too darn hard to call in anymore. So we'll see you in a few months.
Mayor, thank you for participating, and thank you for your comments. We are in close communication with the League of Municipalities and the County Commissioner Association about those very concerns. Excuse me. Contrary to popular belief, when it comes to any of these things, it can be labeled as a benefit change or benefit additions, and those groups are very interested in how we make fundamental changes to the plan so that the plan can be sustained and give especially the small towns and counties the certainty that they so desperately need. So thank you very much. Lars?
I wanted to say again that retirees are getting their checks every month. That's very important. They definitely need them and deserve them. However, we do have to pay attention to risk. One of the things about the inflation that has just been mentioned by one of the speakers, that's going to lead to increased salaries over the next few years as it continues to stay high. And increased salaries over the next few years means that the retirees in the future will be retiring at more. And the plan has to be ready for that. Increasing risk at this time doesn't seem to me to be a good way to prepare for the future.
Thank you. And you've been there, right? Thank you all very much. Just some brief comments before we adjourn. We've already talked about interest rates. I meant to bring an article in here. You've heard me talk in the past about the spigot. People are not entitled to their own facts. As I've said many times before, we have crossed the precipice in terms of the life of this plan, where there are less people paying in the plan than are not. And that's an absolute fact. It doesn't mean that everybody who's not paying in the plan is getting a retirement check. We have hundreds of thousands of people who are vested in the plan. They're not yet eligible to draw, and they're not drawing. And that matters when you need that money coming in every 30 days to help for the checks to go out. And the article I was going to bring in, I think is from Duke University, where in the second quarter of 2020, they just stopped making 401k matches. They just stopped. We can never stop. Our spigot can never be turned off. It can never be turned down. It's always going to be turned up. And that's an absolute fact. So I just wanted to tell you that. Secondly, or lastly, I just want to applaud not only the people in this room, but are in this building. You're seeing and hearing reports of maybe not as much state agencies, but federal agencies where people literally have not been in their offices for 2 years. And I can look out across this room and across this building and across this parking lot and tell you that generally speaking, our lights have been on during this entire crisis. And there are a lot of people that are behind the scenes that keep us in the check delivery business, who don't come into the IAC meeting, but they're answering calls and they're helping people. People don't call here to book a cruise. They call here because they have a serious life-changing event. Most are blessings like retirements. Some are not blessings like loss of a spouse or someone who's killed in the line of duty. And we've been here the whole time. We don't have expiring ketchup and mustard in our refrigerators because we've been using it the whole time, right, Jeff? And so I just want to close our meeting with a round of applause, not just from the folks here in the IMD division, but across all of OST, whether it's C-Cash, State and Local Government Commission, Retirement Division, State Health Plan, Pharmaceutical Benefit, State Banking Operation, and all the others. I just think that all the employees here deserve a round of applause because they have, as I said earlier, these lights have been on during this entire crisis. We've had fits and starts. I've, of course, had my fit and start in March of 20. We've approached this with a level of common sense and common courtesy, which I thought was necessary to keep us operational. And it's sad that over this period of time that things like masks and vaccines have become so politicized. Everything just has become politicized. We continue to operate with common sense and common courtesy. It does matter what the governor says, but just because the governor says we don't have to wear masks doesn't mean that people in common areas can't do that. And I can tell you that no one in this building is going to be looked down on or in any way, shape, or form if they choose to continue to wear a mask, regardless of what the governor applies to the state government. I'm going to continue to try to wear my mask just out of respect and courtesy of others. So anyway, with that, I'll entertain a motion to adjourn.
So moved.
Second.
Motion second. Any further discussion?
Oh, sir, we forgot the round of applause.
Oh, yeah, let's go. Yeah, thank you. No further discussion. Clerk will call the roll.
Mr. Anarella,
Yes.
Mr. Brewer,
Aye.
Mr. Mevin, Treasurer Falwell. Aye.
Okay. Thank you all very much. We're adjourned.
Thanks, everybody.